Good evening. On behalf of the School of Economics and Business at the University of Barcelona, it is a pleasure to introduce this closing ceremony of the EFMA annual conference, which includes a keynote speech, an awards ceremony, and a Human Towers exhibition. It has been a great honor for the School of Economics and Business at the University of Barcelona to host this year's conference, and this for several reasons. First of all, because of the topics of the conference. They are of a great interest given the current situation in Catalonia and Spain. For instance, lectures such as the EU and Greek sovereign debt crisis, banking and sovereign crisis, housing, and the macroeconomics could not be of most interest in the current situation nowadays. Unfortunately, I miss them, but I will ask Marta for the papers delivered in these conferences. Secondly, sessions were of a great level. Many of the best researchers in the world in the field of financial management were here. And thirdly, because of the interest for us of the fields of risk management and international finance, given that this is one of the strong fields in the research in the School of Economics and Business, and it also has a specific research center devoted to these topics, the Risk Center. It is therefore for all these reasons that I would like to thank all that made this conference in Barcelona possible. First of all, the sponsors that made it possible, mainly CaixaBank, who is also sponsoring this keynote speech, but also Barcelona Centre Financer Europeu, Borsa de Barcelona, Barcelona's stock exchange market, MEF, the market of futures, the Ministry of Economy and Competitiveness of the Spanish government, the Risk Center, this research center, another research network, SHREAP, and the Department of Economic Theory. They all gave a little bit of help to finance this year's conference. I also would like to thank John Docas for having chosen the University of Barcelona to host this year's conference, and the two co-chairs, Marta Gómez-Puig and Elena Chulia, and all the local committee that was all made by University of Barcelona's lecturers and professors who made a very good work to make it possible. And particularly, I would like to thank the keynote speaker, Professor Subrahmanyam, for having accepted to give this year's final lecture. Dr. Subrahmanyam, and I'm sure I'm pronouncing it not very well, is an expert in behavioral finance and economics who is known for his path-breaking research in the use of psychological principles to explain stock price movements. He has used his behavioral expertise to explain spikes in gasoline prices, and he has studied the effect of war on the stock market. Dr. Subrahmanyam's current research interests range from the relationship between the trading environment of a firm's stock and the firm's cost of capital to behavioral theories for asset price behavior and empirical determinants of the cross-section of equity returns. Founding co-editor of the Journal of Financial Markets, Dr. Subrahmanyam is the author or co-author of numerous refereed journal articles in leading finance and economics journals. He previously served as associate editor of Review of Financial Studies. He is a member of the Working Research Group on Market Microstructure, recently established by the National Bureau of Economic Research, the NBER. For his scholarly efforts, he has received Best Paper Awards at the Western Finance Association meetings and the International Conference of Finance in Taiwan, and was honored with the FAMA DFA Prize for the Best Paper in Investments published in the Journal of Financial Economics in 2000, and the Smith Breeden Prize for the Best Paper published in the Journal of Finance in 1999. He has also served as a consultant to the Nasdaq stock market, the National Stock Exchange in Mumbai, in India, the San Jose Mercury News, and Irwin McGraw-Hill. He's currently a professor at UCLA, and his keynote speech today has the title, Time Variation in Market Efficiency. Professor Subrahmanyam, the floor is yours.
And can I get my mic? Oh, okay. Unfortunately not yet. Okay. Okay, well, thank you very much for the kind introduction, Dean Luzzi, and thank you so much to the organizers and John Dukas for giving me the opportunity to talk to you about my current research. Also, it's been my privilege to be associated with the EFMA journal, which now is, in fact, the leading European journal in finance. And it's been my privilege to publish several papers in this journal. And I think that Professor Dukas deserves all praise for starting this venture and maintaining this venture, which is extremely important to make sure finance remains international in its focus. So thank you so much. So my talk today is going to be focused on time-varying market efficiency. Like I said, I'm going to go on for about 40 minutes or so, and then I'm probably going to take a few questions if you have any. So my goal is to talk for no more than 40 minutes. As the title suggests, basically what I'm going to do is to talk about market efficiency. And I think that this is important because one of the main issues when we teach MBA students is how to present the topic of market efficiency. You know, some people think of it as the market being efficient. Some people say market is not very efficient, where efficiency simply means how good prices are at incorporating relevant information. In other words, is the price right? The problem with this is that we tend to think of it as a static concept, and some of us think of it as the market being efficient, and some of us think of it as the market not being efficient, but we don't completely recognize that there's a dynamic element to market efficiency which needs also to be understood. So what I'm going to do today is to tell you something about the research I've been doing on the dynamics of market efficiency. And as the slide suggests, I'm going to do it looking at two efficiency metrics, a very short horizon efficiency metric and a longer term metric, which is the cross-section of monthly stock returns. That's sort of a longer term measure of efficiency. So what I'm going to argue today is that efficiency is dynamic in ways that you might predict or may not predict. And then we're going to draw implications from the results on efficiency dynamics, and maybe we'll learn better in terms of how to educate our students, which also is an important part of academia. Not only is it research, but it's also about how to teach students in the right way or the appropriate way or so on and so forth. So whether you agree with me at conclusions or not, at least maybe hopefully you'll get new perspectives on how to educate students about finance, right? So that's the idea. So without further ado, let me just get into my first piece of evidence that efficiency, in fact, is time varying. So my first piece of evidence on this is based on a series of papers I've written with my co-authors Chordia and Richard Roll. One's a former PhD student of UCLA, and one's obviously needs no introduction, Richard Roll of UCLA. So in this, I'm going to show you some evidence from a simple regression that we ran in these papers, which has been updated to more recent data. The regression is a very simple regression where we estimate the predictive relationship between return and something called order imbalance. By order imbalance, I mean it's simply the net buying pressure. And what we showed in these papers was that the market wasn't fully efficient, that you could predict future returns, which is the return sub t, from OIB t minus 1. So now there's a predictive relationship, okay? And these are extremely short horizon regressions, so the horizon here is no more than 2 to 5 minutes, okay? However, we still think it's useful because in this day of algorithmic trading where people are trying to make money based on 2 or 5 minute returns, it's still useful to talk about the efficiency in an intraday setting. So this regression that I've specified here is a very simple OLS regression, but basically what it is that it's over horizons of 2 to 5 minutes. So think about this regression as being run over periods of a month by stringing these 2 to 5 minute period returns, predicting them from order imbalances, which is the net buying pressure, you know, how many on net, whether people are buying or selling, and then calculating the average R squares from these regressions. That's all there is. So the bigger the R square, the less efficient the market, because in an efficient market, you should not be able to predict the future from the past. That's the idea, right? So I'm going to show you a picture that's quite interesting because it tells you how efficiency has evolved. Now, this particular picture tells you how this R square has evolved over time. If you take a look at these R squares, there's absolutely no question that, remember, short horizon efficiency is inversely related to R square, right? So the bigger the R square, the more reliably you can predict returns. So if it goes the other way, it means the market's becoming more efficient. This evidence is for the United States. And the 4 colored lines, you don't need to worry about it for the purposes of this talk. They're just simply different ways to measure returns. So the first 2, red and purple, measure it using 2-minute returns using slightly different methods, using 1-minute returns using slightly different methods. The third line measures it using 2-minute returns, and the third measures order imbalance by the number of transactions, the number of buys minus the number of sells, as opposed to the dollar level of imbalance. So you can see from this that the R square has actually dropped dramatically over time. So it was around like between 5 and 10, or 10% almost in the early part of the sample period, and now it's declined steeply over time. So you can see how efficient the market has become over time. And this sort of suggests to us that even if we believe the markets weren't efficient in the 90s, now we should probably start believing that they indeed are actually quite efficient these days. So you can see that efficiency, in fact, is indeed a dynamic concept, right? So you can see the effect is quite dramatic as to how steeply this particular R-squared graph has fallen over time. Why this has happened is not hard to guess. I mean, there's algorithmic trading, there's computerized trading, there's people trying to make money in 2-minute returns, and every predictive relationship in the finance literature is exploited. So you could argue that papers in the 90s that sort of showed that you could predict returns actually were exploited by professors who consulted for investment banks and hedge funds, and by people who read the Journal of Finance or whatever else journal, EFMA journal, whatever you want to pick up. And actually, this is really efficiency working in real time. You can see the markets become more efficient. In fact, it's virtually completely efficient because the R-square is very, very close to 0 in recent years. So that's my first piece of evidence on this regard. Okay. So moving further along, I am stuck. Yeah. So the next thing I'm going to talk about is provide you some evidence on another aspect, which is something that's probably more appealing to many of us, which is talk about trends in the efficiency of the cross-section of monthly stock returns, which is that, as you know, if you move away completely from this 2-minute, 5-minute deal and move more into a longer-term perspective on market efficiency, and think about something that we all like to think about, which is how predictable are returns in the cross-section. There's a lot of literature done on work like momentum, book to market, things like that, that many of us are intimately familiar with. But a fundamental question to practitioners and academics is whether stock returns are actually predictable in the cross-section, and how predictable are they? Because that's the basis for whether you want to do active management or passive management. Active management means you're actively trying to identify mispriced stocks, and active managers don't invest over 2 to 5-minute horizons, they invest for the longer term. So what they would like to know is what's the evidence on whether stock returns are actually predictable over the longer term, which would tell them what kind of strategy they should follow, right? And so the question that arises here again is, well, what's been happening in this dimension over time? So let me give you some evidence. This particular piece of evidence will require a little bit longer exposition because it's, in my view, a more important topic. You know, it's a topic of first-order importance. So let me proceed and give you some exposure to this particular topic. Now, trying to understand this topic, let's first think about why there should be cross-sectional return predictability over longer horizons. Let's just pick a month for simplicity, okay? Just a month. So why should returns be predictable over horizons of, say, a month? Well, there's two reasons that we tell our students. One reason is that stock returns are predictable because of risk. And the idea there is that the more risky the stock, the bigger its required return, so you can predict its return from its riskiness, like the standard beta coefficient that we teach our students. Of course, in recent years, as you've seen in the sessions and in research, that another angle has picked up, which is inefficiency. Inefficiency means that prices aren't completely incorporating all of the information available out there, and so returns are predictable because prices are not fully efficient in incorporating the available information. So that would be an inefficiency that could also lead to predictability. Now, the important thing to note, however, about this inefficiency that's occupying all these journal pages, and on which I also have written some papers, is that it's fundamentally unstable, right? So if people find out about an inefficiency, then it should go away. And that's an issue that is important to recognize in terms of distinction from the risk angle. The risk angle is relatively stable, right? So you don't, if the CAPM works today, you don't really expect it to stop working next 5 years. In next 5 years, the reason is that people basically price stocks according to CAPM, if that's the case. So agents behave in a certain way, they're not going to change their behavior. But inefficiency is a different animal, because there's two ways to make it go away. One way is that a bunch of people make some mistakes in pricing stocks, and once they learn, the mistake goes away. The other possibility is that a bunch of people take advantage of the people who make mistakes and trade, and therefore it goes away. So for both those reasons, it's basically unstable. And that's, I think, an important issue, because we cannot just say it's inefficiency and stop there. We need to analyze the dynamics, is where this research is coming from. So let's recognize that first. So the evidence I'm going to present to you today has to do with the simple issue of how has this cross-sectional predictability changed in recent years. And we're going to do it for the USA, and we're going to do it separately for what we call liquid and illiquid stocks. So liquid stocks are those that are easier to trade, that have lower trading costs, and illiquid stocks are those that are harder to trade. How we define them we'll come to a little bit later, but for the moment, we're going to do it stratified in that way, also separately for NYSE and NASDAQ. Okay. Now, one could argue, like, why are you looking at this recent period? What's the big deal? I mean, why is it interesting? Well, we argue that it is, in fact, interesting. And the reason is because of two pictures I'm going to present to you. So I'm going to motivate why looking at this particular period for examining evidence of cross-sectional predictability is actually interesting. The first picture that motivates this is to simply take a look at a picture of representing average turnover over time in a JFE paper that I published with Tarun and Richard Roll. What this is plotting on the y-axis is monthly turnover. Turnover is defined as the shares traded on the NYSE divided by shares outstanding. Okay, so it's just how many shares turned over. You can see that this particular chart shows you that turnover has increased from 5% to about 45%, and then at the height of the crisis, and it came down during the crisis. So there's some crisis effect there, but still, at least it's increased by about 7 to 8 times. So you can see that there's a huge increase of more than 600% in turnover. And that is unprecedented. So if this is from 1993 to 2009, if you go back about 15 years backward from 93, it's flat. It's 5% flat. So this acceleration is unprecedented, at least in modern times since the Second World War. We have never, ever seen such an explosion in volume. Why that's happened is a separate issue, technological innovations. We're not going to get into that. But it has indeed happened. So that's my first picture. My second picture tells you something about costs of trading. So if I simply plot the bid-ask spread over time, and there's two graphs which overlap very closely. One is for small orders, less than $10,000, and the other one is for large orders, more than $10,000. But the pictures are so closely overlapping, we don't need to make that distinction here. You can see that spreads also have decreased tremendously over time. As a proportion of the price level, they were 0.35 in 93, and now they've declined to 0.05. So again, it's an unprecedented decline in trading costs, which of course they went up because of the crisis, but now again they've come back down. Again, there's quite an unprecedented decrease in these trading costs. So you can see that the current period is special because of the increase in volume and the decrease in trading costs. And The reason this is important is that, well, clearly it's cheaper to trade, right? It's easier to trade because of so much volume, it's much easier to do an arbitrage, right? Because now there's much more volume to hide between. I mean, if the trading is thin, you're not going to be able to make big transactions, and now you can easily do so. Similarly, since the bid-ask spread is lower, you can conduct arbitrage more easily. So obviously, it's an important phenomenon that we need to explore. So that's basically why looking at the recent period is interesting, because of these phenomena: increase in volume and decrease in trading costs. And the question is how that translates to market efficiency. Okay, so I'm going to argue to you that the evidence that we have, it's somewhat controversial, but we find that this predictability has virtually disappeared for liquid stocks, but not for illiquid stocks. That doesn't mean that we shouldn't do behavioral finance, but it does mean that it's something to think about. Now, I was telling you that I was going to define liquid versus illiquid. These are basically definitions based on something called the Army-Hood liquidity measure, which is essentially the following simple construct. You take the absolute return of a stock divided by dollar volume and average that number across a month. So it's so again, absolute return over volume, average it across a month, and that's called the Army-Hood liquidity measure. It's simply a measure of how much the stock price moves per unit volume. But that's not critical. For those of us who don't want to get into the actual measure, you can just think of it as liquid and illiquid. So liquid stocks in the study is defined as stocks whose Army-Hood value is lower than the median. They're easier to trade. And illiquid stocks are those for which this measure is higher than the cross-sectional median. They're harder to trade. That's the idea behind liquid and illiquid. Median is simply the cross-sectional median. Okay? Right, so this is what we find. Now let me give you some evidence on this. So the predictive variables we use are very similar to what the literature has used earlier.